test. Oh, also on Tuesday, I'm going to go over with you what the mark breakdown is on the final exam. So I'll show you like how many questions there are and what the mark breakdown is. I hope you'll be pleasantly surprised. There are actually a lot of multiple choice questions on it. I mean, in some cases, there are multiple choice questions that you might have to take your calculator out for and do some math, but and for those, obviously, extra marks are allowed. But there's only really 2 questions of substance, and as I mentioned, there's a short capital cost allowance question. So I'm just sort of giving you some idea of what to expect. As with any exam, please read the whole exam first. Do the questions first that you want to do, and don't worry about the order. Just tell me which question you're working on, and I'll be happy to sort of work around your order. Please go to Chapter 13, Review Question 7. Let me show you a situation. I own 2 companies. And this one carries on an active business. And this one just has a pile of money in it. And my active business needs some money. So the active business borrows money from this company. So it gets cash, 100, and loan payable, 100. This company gets debit loan receivable, 100, and credit cash, 100. So pretty straightforward. Nothing to do with taxes or anything like that. It's just financing that I need. And this company pays interest to that company. This company is deducting the interest from active business income. That makes sense, right? If this company had a bank loan and was deducting interest to earn active business income, the income would go against its active business income. What type of income is the interest to this company? Normally you would say, well, it's interest, so it must be SIB income. Turns out that when you have 2 associated companies, as they are because they're under common control, my control, if this one is paying something to this company that is deducting against active business income, it is active business income to this company. So this would be small business deduction on this interest income, and there would have been a reduction of active business income and therefore reduction of amount eligible for small business deduction in this company. So review question 7 says interest income and or rental income earned by one CCPC may be treated as specified business income. At the same time, income from the same source earned from another Canadian-controlled private corporation might be treated as active business income. Why is this? Because they're associated, and this happens only if they're associated, and because the Income Tax Act says so. And to what extent will the rate of tax be applied to that income be different for the 2 corporations? Well, actually it'll be the same unless they're sharing the $500,000 capital gain exemption. If this company's hogging it all, then this company won't get any a $500,000 small business deduction. If this company's taking it all, then this company won't get any against its active income. Active income in this case being the loan interest income that it earned from its associated corporation, which this associated corporation used to earn active business income, and which therefore deducted the interest from the active business income. Where does it say this in the textbook? I can't find it. But it's an important rule, and I really wanted to mention it to you. Where's the rule in the Income Tax Act? I think it's 129 bracket 4. Please turn there. See if I'm lucky. I'm feeling pretty hot today. Ah, 129 bracket 6.
So close.
So that's enough on that. So, and I'm a smart shareholder, and I have my corporation, and I've got a pretty good idea of how it works when my company makes money, and I understand how it's taxed. So if it's SIB income or if it's active business income or whatever, and I know the whole deal about refundable Part 1 tax and so on and so on. And I also know that if I take out a dividend, I pay tax personally. I'm saying to myself, this company's building up cash, and that's what I need for my lifestyle or what have you. Why don't I just borrow the money? Because borrowing is not a tax deal. I mean, it's not income. It's just on my personal balance sheet, debit cash, loan payable to corporation. There's no income in that journal entry. So the Income Tax Act says, no problem, okay to borrow. We're just going to put some limits on it. The borrowing can't be out there forever. We'll let you borrow within limits, and here's what they are. I always draw a picture for this. Let's say I got a corporation and it's got a March 31st year end. So, like 3 days from now. So 3/31/13, 3/31/14, and 15. So I got sort of 3 taxation years. And I borrow $100,000 here. I borrow $100,000, and let's say, just for sake of discussion, that these dotted lines will be calendar year ends. So this will be 12/31/12. So it goes December 2012, March 2013, December 31, 2013. I borrow $100,000 here, so this is kind of like, let's say, January 2013. I am allowed to keep that loan outstanding, but if it crosses 2 balance sheet dates of the company, 2 taxation year ends of the company, 1, 2, and let's say I repay it here. So the complete transaction, sometime in early 2013, I borrow $100,000, and sometime in 2014, I repay $100,000. I, in the meantime, have crossed 2 corporate taxation year ends. And honest to God, I draw this picture. Please draw the picture on the exam if a question like this comes up in the exam. Since I've crossed 2 of those, that's deemed to be income to me.
Wait, didn't you just mark off the date that you, isn't your year end December 31st?
No, it's the corporate year end. What's important here is the corporate year end, and I've crossed 2 corporate year ends.
So what's the 12/31? Oh, okay.
This $100,000 is now taxable to me because I kept the money too long. Revenue Canada says we're going to treat it like it's income. Okay? In what taxation year on my tax return does that show up as income? I have to refile my tax return for this, my taxation year, 2013 to include $100,000 in my income. Now, I didn't know that it's taxable to me until it crossed the second corporate year end. I didn't know it's taxable until April 1st, 2014. I have to report it in 2013, the year I took it out, the year I received the cash.
What kind of income is that?
Just regular income. I do not get any dividend tax credit or anything like that. It's just regular income. Oh, and the corporation doesn't get a deduction. This situation is to be avoided at all costs. But it's something you need to know to be able to advise people not to get caught. There is good news. There is light at the end of the tunnel. You recall that I repaid the loan? I do get a deduction on my personal tax return in my taxation year that I repaid it, which in this case is 2014. Why does the Income Tax Act make us do all this? They really don't like the idea of people taking money out of the company. They think it's like, well, I avoided tax on a dividend or something. So they put us through this to make us report the amount that we took out in the year we took it out, my taxation year. And I do get to get a deduction, but in my taxation year when I report it, which means I'm out of pocket some interest because I have to pay some tax and I don't get a deduction until here. So I'm out of pocket personally that I had to prepay some tax. Yes?
So is this a situation where the owner withdraws or takes money out of their own company as a loan?
Yes, that's right. Yes.
What kind of a deduction do you actually get?
A deduction under Section 20. I think it's 21J. So remember, Section 20 has a whole bunch of deductions like capital cost allowance and stuff.
Oh, yeah.
All I get is a straight deduction for $100,000.
So it goes down in those special reductions?
Down in those, yeah, not in like D, but to arrive at income from, I don't know what source, to be honest with you. It doesn't matter.
Okay, doesn't matter.
No. Okay, this is the easiest. I'm going to give you one level tougher. What if I repay the money sooner? So in this case, I repaid it sometime over here. If I repay it here, which is sort of January 2014, because this is December 2013. This is March 2014. So let's say I repay it in January 2014. Then I'm cool, because I repaid it here, which is before the second corporate year end. So I'm good. But what if I say, okay, well, I dodged that bullet. I'll just borrow $100,000 again and we'll do it again. They call that a series of loans and repayments. Just a judgment thing, just kind of looks odd because I'm borrowing, repaying. They're saying, you know what, we're going to treat it as if it wasn't repaid. And sometimes really bad consequences happen because we may never qualify for a deduction here. So a series of loans and repayments is to be avoided as well. Now, on page 515, here's how they set it out. They say, everybody there? What they say is that there are 4 exceptions I don't need you to know what those exceptions are. In a question, if I just say the employee borrowed money, assume that none of the exceptions apply. So they just better have repaid it when they should. I'll tell you though that a lot of business owners say to themselves, well, I must qualify for these, and they're good exceptions. So for example, if I borrow to buy shares of the company and stuff like that. But for the most part, these only apply if they're available not just to the shareholder, but to other employees as well. I gotta tell you, there aren't too many companies that offer employee loans, broadly speaking, and generally, therefore, these exceptions won't apply. Your takeaway is to make sure that your clients are respecting this 2-year rule and make sure they're not into a series of loans and repayments. I just want to say one more thing about this, which is, in this case, it's pretty simple. We start with $100,000. Let's say that we start out with the employee having a shareholder loan receivable, so the company owes me money. So this is my personal general ledger, and I've got an account called accounts receivable from company. And it's in a debit balance, which is great. And let's say it's $200,000. And that's on March 28th, 2013. And again, my company has a March 31st year end. Let's say that on October 1st, 2013, I take out of the company $350,000. Now I have a balance payable to the company of $150 as of October 1, 2013. I'm treated as if I borrowed that money on that day. So if we start in a scenario where the company owes us money, it's okay for us to take money out. But as soon as we cross the line and now we owe the company money, that's when this clock starts. So if I don't repay it by a certain date, it'll show up in my 2013 income because this turned into a debit balance, a credit balance on that day. I borrowed more from the company, or I took more money out than the company owed me. Now remember I said the year end here is March 31st, the corporate year end. By what date must I repay this loan if I don't want section 15, by the way, to apply to me?
March 31st, 2015.
March 31st, 2015. Because the first year end is 14 and the second is 15.
And you have to repay it by that day or before that day?
I have to repay it on or before March 31st, 2015. In other words, if it shows up on my company's balance sheet as an asset on March 31st, 2015, then this rule will apply to me. Be all right with you. And please briefly turn to section 15, bracket 2. Where a person is a shareholder of a particular corporation and has received a loan or has become indebted. So my first example was I received a loan. In this case, I have become indebted because the company owed me and now I owe the company. I became indebted. The amount of the loan or indebtedness is included in computing the income for the year of the person or partnership.
That doesn't say anything about crossing
turn to 2.6. Section 2 does not apply to a loan or indebtedness repaid within 1 year after the end of the taxation year of the lender or creditor in which the loan was made or the indebtedness arose. So that's the rule, that if it crosses 2 balance sheet dates, it's taxable. But 15.2 is the one that says it's taxable to me in the year that I received the money. Please turn to page 526.
And it's,
526.
you said it says it crosses 2 corporate units.
2 corporate year ends, not 2 personal year ends. That's why I chose March and not December as a year end for my company.
Thank you.
Does that say 2010, 10/1/2010? Or 10/1/2010 for the middle, or 2011?
Was that your question? I apologize.
No, that's my
Thanks.
question, thank you.
SR&ED, also called SR&ED, is available to both large and small companies. And I just need you to know that CCPCs, if you look at page 527, and it talks about a 35% rate, this is actually big time and was a large part of my professional practice, which was helping companies identify when they were doing mostly experimental development, like for example, creation of computer programs, improved manufacturing techniques, new products, that type of thing. So it's not just sort of lab coat, sort of scientific research, it's also really practical development, sometimes done on the shop floor of a manufacturing company. Company could get a grant, essentially, this credit, of up to 35% of their costs. So for example, if they spend $100,000 in materials, they can get a $35,000 tax credit, which is actually pretty good. And Manitoba, on top of that, provides a 20% tax credit. So I just need you to know the 35% federal credit for CCPCs, and depending on how it goes, they can get that on $3 million annually of qualifying expenditures. And if they do more than $3 million, and by the way, that happens, it's 20%, which is still quite lucrative, and it's 20% for non-CCPCs. That's all I need you to know.
Is that over 3 million, no cap? for the
No cap.
20%?
There are companies that claim billions of dollars per year. In fact, I think RIM and Nortel were the largest claimants in Canada, and obviously high technology companies doing a lot of mostly experimental development.
If you asked us a question about that, you would tell us they were qualified expenses?
Oh, yeah.
Oh, yeah.
It's actually a pertinent question, because the science or art of determining whether the expenses are qualified or not is actually really complicated. And it mostly takes an engineer to figure that out. Accountants actually don't do well sort of guessing at that. It's really engineers that have to figure that out, seriously. Now, I promise you that on chapter 13, we're going to have some time to do some questions in class or at the review session. But if you don't mind, I'd like to proceed with chapter 14. I also hope you had a chance to look at my suggestion on how to approach these things and what to do first and second and stuff. It's really critical, and I won't repeat it here because hopefully you've read my message on that. And you'll let me know perhaps by the bulletin board or other ways if you're having trouble on the weekend attempting some of these questions.
No worries there.
Chapter 14 and chapter 18 were essentially my world. I worked a lot on reorganizations and sales of businesses. And A, it's a lot of fun. B, it's really complicated. But C, it's where I could really make a difference for clients, and I'll show you some of those ways. So chapter 14 starts out talking about, on page 560, asset transfers. what's a reorganization? So I own a company. And inside the company there are assets and liabilities. So A for assets. Any change I make to this, we call a reorganization. So for example, if I move the assets into another company, that's a reorganization. And you already know how to do that. That's a Section 85 reorganization. Or if I combine this company with another company, that's a reorganization. Or if I set up another company to own this company, we call that a holding company. That's a reorganization. So all these things we call reorganizations. And the first type is an asset transfer, and I won't say much about that because it's Section 85. I'll just tell you though that Section 85 works between corporations as well as individuals and corporations. So for example, you all know that if I was running a proprietorship with these business assets, I could set up a company, and that's a rollover symbol, by the way. And transfer those assets from here into here. That's a reorganization. And if, let's say I had 2 companies, and this one had assets, I can roll those assets into here as long as I take back shares. This company takes back shares of this company. That's also an okay Section 85 rollover. So rollovers aren't just between individual and corporation, they're also between corporation and corporation.
They had to take a share in the first case too, right? They had to take a share in the first case too?
Yes, I had to take a share in this case, and this company has to take a share in this case. You always have to take a share back on Section 85 elections.
Regardless of whether you're an individual.
Exactly.
Thank you.
And that's to avoid taxes, right? The share?
Is to avoid taxes, to give me a rollover, and a rollover means that I don't pay tax in that transfer, and other things apply like reduced ACBs and stuff, as you heard from Chapter 12. I'm going to skip to amalgamations, page 563. I got 2 companies. I decide for some reason I want to combine them. Here's a good reason. This one is making money like crazy. This one is losing money like crazy. I'm paying lots of tax here, and I'm just accumulating losses here. The losses can be carried forward, but I'm not expecting any income anytime soon here. You know what? I'm going to smash the 2 companies together. Amalgamation. Totally tax-free. All of the assets of this company and all the assets of this company just now become assets of this company.
Does that still work like for Chapter 11, if you purchase a business and you carry the non-capital losses forward, can you then amalgamate after you've made the purchase to bring the losses in, or no?
You can in this case because this is like a non-arm's length purchase because I own both companies.
Yeah.
But if you and I each owned a company and this one had income and this one had losses,
Yeah.
and we amalgamated those, I wouldn't automatically be able to use these losses. They'd be subject to the same restrictions from Section 111. So you can't use an amalgamation to get around the change of control rules. Is that okay?
Yeah.
Section 85 rollovers are in what section?
85 maybe?
This is 87.
And that's because?
And that's because there's about 4 or 5 sections that are all sort of tightly grouped. We'll talk about them. And Section 87 just happens to be one of these, and it's close to Section 85. Now, I did ask you to read Section 85, or at least be able to understand sort of how it fits in with doing a rollover. I actually don't care if you read section 87 or even know about it, but I'm just letting you know that there's a portion, there's about 30 pages of the Income Tax Act that are all related, and all of them are tax-free rollover transactions, and section 87 is one of them. The assets of this company and this company move into this company at whatever the tax values were of these two. So whatever the UCCs or the ACBs were in here, just fall into here, and that's as it should be. A deemed year-end happens. So we have a stub period return. Let's say that this company had a December year-end and this one has a December year-end, and this amalgamation happens on March 28th. These companies have to file a stub period tax return from January 1st, 2013. Marlo's watching my numbers carefully here, so I'm going to write more neatly. To 3/28/13. Stub period tax return for both of these. The amalgamated company, which started on March 28th, can choose whatever year end it wants. So if it wants to, it can go back to December like its predecessor companies, or it can choose April or November or whatever's good for it.
Do you have to do another stub period tax return again, just like the other time?
Yes, if it picks December, then it has to do a stub period tax return itself from March 29, 2013 to December 31, 2013. And that's as it should be. Amalgamations, this is called a horizontal one for obvious reasons. Also, we can do a vertical amalgamation. Same rules apply. Combination of these two companies, stub period, year ends, and assets transferred to the big amalgamated company at tax values.
So when you amalgamate the two companies, A and, like if you call them A and B, they don't exist anymore, right?
They don't exist anymore. They're just wiped off the books, both from a tax standpoint and also, you know, the provincial registry or wherever they're, whichever law under which they're incorporated. The choice there is provincial or federal.
But you're saying these are always non-arm's length?
They can be arm's length. But then the acquisition and control rules might apply, and any losses are restricted.
Oh, okay.
And let me show you what an arm's length one might look like. So I own this company and someone owns this company. The values are important here. Let's say this company is worth, the shares are worth 5 million, and this company, the shares are worth 15 million. We combine the two. The combined company is worth 20 million, and I get 1/4 of the shares, and this shareholder gets 3/4 of the shares. I think I got that math right. Which means there has been an acquisition of control of this company, and if this company had losses, then the amalgamated company can only deduct those losses according to the reasonable expectation of profit, continue to operate the loss business, those Section 111 tests. So, arm's length deal, they negotiated how much each is going to get in shares, and we just go on our way. Tax-free transaction. Now, there's something similar called a wind-up. Please turn backwards to page
64.
Yeah, not so much backwards. 564. This one only operates vertically. Winding up is another word for it is a dissolution. The company was dissolved. It just no longer exists. But unlike an amalgamation, this company still exists. So I'm going to wind up this company, and its assets go into here, tax-free, that's good. And it no longer exists. But this one, which always did exist, still exists. That's the difference between an amalgamation and a wind-up. On an amalgamation, neither of these companies would exist anymore, and we just have one big company that exists. In a wind-up, this original company, predecessor, still exists, and this one just doesn't exist. There are a couple of distinctions from a tax standpoint, and I'll tell you what they are. First is, to get this tax-free treatment, this company has to own 90% or more. This company has to own 90% of the stock of this company, or else there's no tax-free treatment. It's a different characteristic of a winding up. There's a really good thing here, though. It's called the bump.
Is it a bump?
Bump, B-U-M-P. Here's how it works. I bought a business from a company. It had a piece of land in it. But the owner insisted that the company wasn't going to sell me the land. He insisted that he had to sell me the shares. So I've got my company here, and my company ended up buying this other company, and it's got the land in it. What I really wanted to do was simply have my company buy the land. And I didn't really want his company, but I ended up buying his company, and that's what he wanted. Question is, how can I put this land into here? Plus, I don't really want this company, right? I bought it sort of, even though I didn't want to. I wind it up. And I'll use this as the symbol for that. I wind it up, and my land comes in here. Okay? Now, I paid $1 million for the shares. Because the land was worth $1 million, and the company's got no liabilities. So the fair market value of the land is $1 million, but the cost base of the darn land is only $100,000. And on a winding up, as I said, there's no tax to pay, but it's a rollover, which means the cost base to me of the land is only $100,000 because the cost base to this company was only $100,000. So this is crappy. Now I really wish I bought the land, because at least if I paid $1 million for the land, I'd have $1 million cost base for the land. I'm allowed to do a bump. It's an election where I get to increase the cost base of my land up to what I paid for the shares. So I get to increase my cost base from $100,000 up to $1 million. And it's a beautiful thing. The bump.
What if your share price isn't $1 million?
If my share price was, say, something different from $1 million,
Yeah.
say 900,000,
Yeah.
then I can bump it up only to 900,000 adjusted cost base. By the way, I must have got a real deal there, because I knew that the value of the land was $1 million, but I guess I was able to buy the shares for only 900,000. Now, there's some other variables which I don't need you to know. I'll tell you what they are. What if there's other assets in the company? What if there's liabilities? What if the company's paid some dividends in the meantime? I just want you to know that there is such a thing as a bump. And in a simple case where the company's only got one asset, on a winding up, I can increase the adjusted cost base from whatever stinky small amount it was in the stinky company I bought, up to what I paid for the company, up to my adjusted cost base for the company. And that's a very good thing. Amalgamations are Section 87. Wind-ups, including the bump, are Section 88. On page 565 is an example of this that, if you want, you can read. But it's got way more variables than I need you to know. I just need you to know the ones that we discussed. A bump can also apply on a vertical amalgamation. I need you to know that. And that's discussed on page 563. If you look at the bullet point that says tax treatment, it says in the middle of that large paragraph, it should be noted that a particular tax benefit may occur under a vertical amalgamation if the parent owns 100% of the subsidiary share. The benefit results in an increase in the tax value of certain assets. Certain assets means non-depreciable capital property, just for your interest, and that's why I used land in my example.
It has to be non-depreciable?
Has to be non-depreciable. Referred to as a step-up or a bump, where the parent's ACB of the subsidiary shares $1 million is greater than the sum of the tax values of the subsidiary's net assets, $100,000. This is explained in more detail on the next page. Why couldn't they just explain it on the first page? I don't know. That's why we talked about the winding up piece first. So that discussion and the discussion about the bump on page 565 is all about the same thing. So we've covered section 87 and 88 today, and now let's talk about section 86. Please go to page 567. This example at the top of the page, Exhibit 14.8, is beautiful. I could not have done it better myself. I've had a company for a long time. It is now worth $100,000. I want to be generous. I want to bring some other people into ownership. I don't want to sell them the company, but I want them to participate in the growth of the company. I'm hoping that in 10 years from now it'll be worth $1 million. And I pick people who are close to me, like maybe my children and some key employees. And I own common shares. The common shares are $100,000, worth $100,000. I go back to my company and I give back my common shares and I take back preferred shares, worth $100,000. And as you know, preferred shares are have fixed value. They'll never be worth more than $100,000, and they'll never be worth less than $100,000. So I've kind of frozen my value in the company. Yesterday I owned $100,000 of commons. Today I own $100,000 of preferred shares. We actually call that a freeze. Now I go to the folks who I want to bring into ownership and I say, I will let you buy some common shares, because common shares, as you know, are the ones that appreciate in value. $100 a piece. There are 10 of you. Each of you give me $100. That's a total of $1,000. And you will own the increase in value going forward. So that if 10 years from now the company is worth $1 million, the preferred shares are worth $100,000, and the common shares are worth $900,000. So for that relatively small investment, they have done well. All the growth has accrued to them. And my interest is frozen, and that's the way I wanted it. We'll understand why in a couple of chapters. It's a very good way to share growth in wealth. Not the wealth itself, because I kept the $100,000. but it's a good way to share the growth with employees, family members, that type of thing. Often people will do this as they get older and they say, you know what, I've made my pile and that's enough. If my company increases in value before I die, that's a whopping big tax bill on the later of my death and my spouse's death, right? Spouse will roll over, but then on the death of the second spouse, boom, no more spouses left, capital gain. You know what, I'll just freeze my limit at, or my wealth at 100,000, and my family can come in and have the growth. One of my clients did this when his company was worth $20 million, and he said, you know what, 20 million is enough. If I only am able to get $20 million out of this company, it's fine. And he gave, or didn't actually give, the other family members came in and bought new shares. It's a fair market value transaction. There's no attribution, nothing. They came in with their own money. They bought a small amount of shares, probably $1,000. And today his company, he's turned down $400 million for it. And he's quite okay with that. He froze his thing at 20 million. His family members obviously have done very well. He actually himself bought some of the growth shares. So his interest isn't just the 20, it's the 20 preferreds plus some common shares he's got. But that makes him really happy because when he dies, he knows that, or when his wife dies, they might be paying tax on sort of a 20 or maybe $30 million capital gain, but not the $400 million one that would have happened if he owned all the shares all his life and died holding those shares. And actually when he sees me, he thanks me for that, which is really nice. And I thank him for being so successful. It wasn't my fault that his company did so well, yeah. Holding companies. So this exchange of shares happens under Section 86. And typically what happens is we toss old shares and get new shares back. And that's how it works, and it's pretty simple.
Did you say this is called something special?
No, I said Section 86.
Okay.
Holding companies. I own an active business. It's a hotel. And it's really successful, but I'm always mindful that bad things can happen. Like somebody can slip on a drink or something and I might get sued or something might happen or whatever. So my lawyer tells me that I should do some creditor proofing. I've got $3 million in retained earnings here. And if I get sued, that's a pretty big target. So I'm thinking maybe I'd like to do something. Well, I could pay a dividend. Ooh, I don't like that because I'd have to pay tax on the $3 million dividend personally, and that wouldn't be very good. Well, I can use a Section 85 rollover and roll my shares into a holding company. We call this a holding company. It means all it's actually doing is holding shares of this company. It doesn't run any business itself or anything like that. It's just holding the shares of this company. And I can dividend all this $3 million from this company into this company. This is all active business income, so there's no RDTOH down here. So there's no dividend refund. And these companies are connected, and connected and no dividend refund means no Part 4 tax payable here. So at the end of doing this, what I've got is two companies. This one has 0 retained earnings, or maybe a small amount if the bank needs me to keep $500,000 retained earnings in here or something. And this one's got $3 million retained earnings. And if what my lawyer's telling me is right, this company actually can't get sued because it wasn't this company that operated a business where somebody slipped and fell. It's this company, and all of the equity has been stripped out of it. This has nothing to do with tax planning or anything like that. It's to do with creditor proofing. But the Income Tax Act provides us a way to do this efficiently because the dividend here is subject to no Part 1 tax, You recall dividend included in income, $3 million, and then dividend deducted, $3 million, section 112. So no Part 1 tax and no Part 4 tax because there's no dividend refund. But even if there was a dividend refund, like maybe this company had a capital gain sometime in the past, that's not such a big problem. Because this company would get a dividend refund, and this company would pay Part 4 tax. But whatever, it's the same amount. Like maybe this company got a $50,000 dividend refund, and this company had to pay $50,000 Part 4 tax. Well, maybe this company just pays an extra dividend to help this company pay the tax or something. It's really not a big problem. But again, the usual case is that this company probably has no dividend refund. Therefore, this is a completely tax-free dividend, and this company has been now left creditor-proofed. Had two brothers, clients. They owned a business. One brother was like wife and family, a lot of cash needs. This brother, not so much, pretty frugal, would have left more of the money in the company. Living on his own, sort of not a lot of costs. This guy says, you know what, we need to pay dividends. Or whatever, like I've got to be taking money out of the company. And since I'm taking these dividends out, I guess you are too. No. I don't want these dividends. The company only pays 15% tax on active business income. Like, why would I pay the second level of tax before I really need it? Makes no sense. So we have sort of conflicting financial goals of shareholders. Easy thing to do. Each shareholder creates their own holding company, and the holding company now owns the active company. So again, they've used a Section 85 rollover. They simply rolled their active company shares into their holding company. So this is 50-50. So this one says, I need an extra $100,000. So this company pays $100,000 here and also here, pays a total of $200,000 of dividends. This guy takes his 100 personally and pays whatever dividend tax or whatever, and that's okay. He took the money out, so he's got to pay tax, and he knows that. This one leaves his $100,000 here. And maybe he invested or something. And he's investing with like 85-cent dollars on his share because his share of the earnings here have only borne 15% tax. So he'll grow his money in here, and he'll take it out when he needs it. And he'll pay tax at that time, and it's fine. Each of these two brothers has different goals as to the timing of when they want to take money out, and therefore when they want to pay tax. And having two holding companies allows them the flexibility of each one having his own needs met. Page 571 shows that in structure B. I want to buy a company. But I need to borrow money to do it. I do not have the cash. I got to borrow the money. Good news is the bank is happy to lend me the money. So far, so good. So I go to the bank and I borrow the money. Company's doing well. It's all good. Only problem is, say my loan is $1 million. I want to pay down the principal. How can I pay down the principal? The only way is to take money out of the company. The only way to do that is to either borrow it, but then I gotta repay it. So I take dividends or whatever. So I have to pay tax. And I can only repay this $1 million out of after-tax proceeds. That means that I'm probably taking out somewhere like $1.8 million or something like that in pre-tax income. Paying, I don't know, like $800,000 worth of income taxes to allow me over a few years to pay back this $1 million loan. It's terrible. What I can do is I can set up a holding company and have the holding company borrow. So the holding company borrowed at the bank to buy the shares of this OpCo. When I say OpCo, I mean operating company. Now OpCo can pay $1 million worth of dividends up to here tax-free, and I can pay the bank, or this company rather can pay the bank out of earnings that have only borne corporate tax, not corporate and personal tax. That's a very powerful thing. So using a holding company in an acquisition allows us to repay principal out of earnings that haven't yet been taxed personally, because it's the company that borrowed at the bank, I didn't. Yes?
Why can't the company just pay the bank directly instead of using a holding?
Why can't this company pay the bank directly? Because it doesn't have the bank loan. The holding company has the bank loan. Company can't borrow money to buy its own shares.
I was just gonna ask then if you could amalgamate the companies to roll that all into one.
If you amalgamate the companies, now what happens is this. The bank loan now becomes a loan of the amalgamated company, which is fine, which is good. So this company is now paying the bank loan directly. Not only that, and here's the really sweet part of the amalgamation. The interest on the bank loan is now being deducted against this company's profits. The interest on this bank loan would only be deductible against dividends. And you recall that with a dividend of, say, $1 million, I already get a deduction that completely wipes out the taxable income, because Section 112 reduces my income to zero. Oh, and now I've got some interest expense? I'm just going to be carrying forward losses forever. So having the bank loan here allows me to repay the principal without having paid personal tax. But it's this crazy situation where I have interest expense for which I effectively get no tax deduction because I have no taxable income against which to deduct it. Because my only source of income is dividends from this company, and dividends are already tax-free. So if I add an expense onto that, tax-free minus expense just means losses carried forward, which is useless. But if I amalgamate these two, and the loan becomes a loan of the amalgamated company, which has the operating assets and profits in it, I now deduct the bank loan interest against the operating profits, tax benefit there, and still am repaying the bank loan out of retained earnings that have not yet been taxed or never will be taxed in my hands. So a holding company to buy the target, and then we immediately amalgamate them afterward to get those benefits.
Very smart.
It's just, I used to just love doing, and explain to the client, let me get this, like, I was planning to go to the bank. No, you don't want to do that because like that's crappy because you're going to have to pay the bank loan out of your after tax. Oh yeah, that's crappy. Well, what can we do? What can we do? Well, let's draw some pictures on the board and we'll see what's what.
It's
And
a
honest,
wonder you retired.
honest to God, by the end of it, like, they think you're,
They're giving you their firstborn
and
and buying you lunch.
I tell them, like, if you taken this course at university, you'd know all this stuff. This is a holding company advantage that happens on purchase. Let's see how a holding company could help us on a sale. I have a company for sale, and I've already used up my capital gain exemption. Or my company doesn't qualify for the capital gain exemption or something like that. Let's say my adjusted cost base is $200,000. The fair market value of the shares is $1,200,000. My capital gain is?
What? You're standing in front of the numbers.
My capital gain is
$1 million.
$1 million. The retained earnings of this company is $600,000. How can I make this better? What I do is I set up a holding company. So this is the original company, we'll call it OpCo. And this will be HoldCo. I pay a dividend from OpCo of the entire amount of retained earnings, $600,000. I then have HoldCo do the sale. This is the company that somebody wants to buy. I've stripped out, we call it stripped out, $600,000. What is the value now of the shares of OpCo?
600,000.
It's 600,000 being $1.2 million originally, minus I took $600,000 out by paying a dividend up here. You can visualize the journal entry, debit retained earnings, credit something, maybe it's cash or shareholder loan payable or something like that. But the important part is the debit retained earnings, which means my equity has gone down, and so has the value. So the adjusted cost base here is 200,000 because it was a rollover. So this company acquired the shares from me at 200,000. So now my proceeds is 600,000 minus my ACB of 200,000 is $400,000 capital gain rather than $1 million. Now I do have $600,000 in here, and I will pay tax on that someday, but I can control that. I can control when dividends get paid out of here to me. In the meantime, I've reduced my tax on the sale of this company, and that was the real transaction that I wanted to avoid tax on because I would have had a big hit here.
And CRA doesn't have any problems with all of this?
CRA is completely okay with this as long as we do not exceed the retained earnings. In fact, the retained earnings here has a name, it's called safe income. We can pay a safe dividend of $600,000. If we pay $800,000, they charge us a capital gain on the excess, which is $200,000. Page 574. Is a really good example, and it shows what happens if we pay a dividend higher than the safe dividend. It shows how that all works. So if we paid 800, the fair market value would get reduced to 400. My capital gain would be 200, but then I'd have to add another 200 because I paid a dividend higher than the safe dividend. So I would end up at the same $400,000 as if I paid a safe dividend. And this example on page 574 takes you through that.
You said something about a CD didn't.
Yes, The dividend that I pay here from OpCo into HoldCo can only be as high as $600,000. If we go higher than $600,000, we have to pay tax on the excess portion. They call that a capital gain. And this page 574 example will explain that. Two minutes on chapter 18. That was it on chapter 14. You've all had your chapter 14 explanation. If you read the textbook, you'll be good. And I've posted the do's and the don'ts and all the rest of it. Chapter 18 is going to pull together what you learned in chapters 12, 13, and 14. Chapter 18 is when you have a sale of the business. It's just like the Mary transaction, except that she sold shares. If you can imagine Mary's company selling business assets instead, the following things would happen. There'd be some capital gains. The company would have some capital gains. It would have some recapture. It would have some goodwill gains and stuff. And all that happens is that's various categories of income. Oh, recapture, that's active. Goodwill sale, that's active. Capital gain, that's aggregate investment income. And then we just apply the right tax rates. Okay, this one is subject to the capital gain, small business deduction. This one gets refundable treatment. That's all you need to know to start on chapter 18. If you can read through that before next Tuesday, that would be awesome. After chapter 18, this course is so easy your parents could take it.